Hey, hello everyone. Thank you for joining us on the panel discussion talking about the evolution of bond market, role of financial data governance and credit risk management. With me on the panel is Paige Tan from our pricing valuation reference data team based in Hong Kong, Yoshizawa-san based in Tokyo, heading our products there, and myself, Zaid, also based in Hong Kong, also working in the same team as my colleagues in the pricing valuation reference data. So Yoshi-san, let's start maybe with you giving us just some of the recent updates and developments in the credit market, please, and maybe we'll take it from there.
Sure. Thank you, Zaid. Very happy to discuss with you guys. By the way, so when we look back the development of credit market in very early stage, we only have a specific agency bonds at specific maturity that was traded at similar yield to government yield in the jurisdiction. Then we have more issuers and the maturities of corporate bonds. With that, we started to see the relative value between one issuer to another, or the maturities on the one issuer's yield curves. Then more issuance of corporate bonds that provide us by issuer sector rating type of yield curves that are used for credit investment strategies. And then market developed new instruments called credit default swap, CDS. With that, we can directly trade PD, that's probability of default, and LGD, the loss given default, or recovery rate from the reverse view. And then rating technology developed structured credit and asset-backed securities. With that, we can trade more and more curves these days. So these market developments, we got to have more credit-related market data set that was that can be used for more purposes. One example was CVA, that's credit value adjustment. That is to price counterparty risk of derivative transactions. So CVA is the idea to price ECL, the expected credit loss of counterparty. ECL is calculated from PD and LGD. So CDS market data contributed a lot in modeling CVA. CVA is based on market neutral model. Accordingly, market players can hedge counterparty credit risk by trading the market tradable instruments like CDS. And it was interesting and significant step forward in risk management activities. So CVA risk management worked very well through financial crisis, so that this concept was adopted in regulatory framework. And accounting standards like IFRS, US, and Japan GAAP also adopted CVA, which is called accounting CVA now. So I think it's a good example of market development. So risk taking and hedging demand to create new products traded in the market. The more product we trade, the more market data we have, and then the more analysis and measurement we find. Then eventually new measurement provide better view of investment or risk management that is eventually adopted by regulators, so it contributes to stable financial condition now. So probably we can call it the power of capital market or role of capital market. That is not in the case of only in credit risk modeling, but also in many segments. And I think the ESG, that would be definitely the focus of market in next 10 years.
Yeah, no, I totally agree with you, Yoshi. Thanks for that intro. And maybe just picking up from where you left on the ESG side. Paige, I know you're very much focused on this space. I guess maybe to start off with, from your side, just give us an idea of the size of the ESG bond market specifically, please.
Thank you, Zaid, for the introduction, and also thanks to Yoshi for the summary of the development in the credit market recently. So the current market estimates that the ESG bond market size to be beyond $3 trillion as of the first quarter of 2022. Now, this compared to the global bond market size of beyond 130 trillion may seem small. However, I think market widely expect that the ESG bond market to experience significant growth rate in the next decades, and some even estimate that the ESG bond market size can quadruple by 2025 from the current 3 trillion mark. Just an indication, in 2021 alone, the ESG bond issuance amount hit a record high at $1 trillion.
Interesting. Yeah, I mean, it's pretty fascinating, kind of the growth there, or expectations for the growth of that market in the next few years. I guess when we're talking, just continuing down the ESG bond market path, when we're talking about kind of ESG bond market, I'm sure there are a number of different types and categories there. Can you give us an idea of what are those categories, and maybe we'll dive into one or two of these afterwards?
Sure, Zaid. So I think currently we can group them into 5 main categories that are widely or commonly seen in the marketplace. So we have green bonds, we have social bonds, we have sustainability bonds, and then we also have sustainability linked bonds, and lastly, which is a newer one called transition bonds. Let me just get into a bit of a detail for each of these categories. So green bonds are fixed income instruments where the funds are deployed for projects that have positive environmental or climate benefits. For example, a project that funds renewable energy generation from the solar panel are referred as a green bond. And social bonds are bonds where the funds are deployed for social projects, such as like to promote gender equality or better access to education for poorer regions or countries. Now, sustainability bonds provide funds for projects that might combine the green and social goals together. So often you will find that some of the bonds will be issued with a mandate to achieve several SDG goals. SDG refers to the Sustainable Development Goals announced by the United Nations back in 2015. So this can be when you combine one green or another social goal together, these type of bonds are called as sustainability bonds. Now, the 4th category refers to sustainability linked bonds. So these bonds, you have a financial structure characteristics such as a coupon payment or redemption amount, which can vary depending on whether the issuer achieve a predefined ESG goals, which is usually defined in the form of KPI or SPT. Now, for example, if a bond was issued as a sustainability linked bonds, they might have certain criteria that the issuer must achieve. For example, energy conservation. And if they achieve that, they might actually have a benefit of lowering down their coupon payment on the next coupon payment period. So these are what we call as sustainability linked bonds. Now, the last group is called transition bonds. They are relatively new class of that instruments that was used to fund a company's transition towards reduced environmental impact or lower carbon emissions. So they are often issued in the fields that would not normally qualify for green bonds, such as for large carbon emitting industry, for the likes of like oil and gas, shipping, and aviation. So like the green, social, or sustainability bonds, bonds with the transition label must clearly stipulate how the funding will be used to support for climate goals and also to support the Paris Climate Accord. So with this 5 grouping that's the most commonly seen in the market, the green bond actually holds the largest share market as we speak today.
Interesting. And it holds the largest share, I guess, in terms of, in terms of the projections in the next 3 years. Which category do you think will be, there will be the most focus on? And pretty interested in terms of the transition bond that you mentioned, and even the sustainability linked bonds. Just curious, like when we're looking at these versus kind of, if you like, the more conventional ESG kind of bond categories like the green bonds and sustainability, what do you see the dynamic there? do you see them to be growing faster or same pace? If you can comment on that, please.
Sure, Zaid. So I think when we talk about the grouping that we mentioned earlier on, the green, social, sustainability bonds are, like you put it, they might be a more straightforward with a direct impact on the defined goals, like the green goals or social goals, or combine of the two. Now, when it comes to sustainability-linked bonds as well as transition bonds, they are structured in a way slightly different, but with still an aim to help to assist economy to transition to a greener economy. Now, if you look into the sustainability-linked bonds, they are actually linked with KPIs or SPP. In that sense, is usually the funds are used to deploy for maybe a working capital purpose, but then you can have some environmental KPIs to achieve while you spend your day-to-day operation. So this, again, is helping the whole economy to transition to a greener or a less carbon-intensive operating models. Now, again, when we say about that, the green, social, and sustainability bond might be the first 3 batch that was available in the market. Their market share has grown quite stable over the years, but we probably see more traction on the sustainability-linked bonds as well as the latest addition, which is the transition bonds. So transition bond is relatively new to the market, introduced in the past 2 to 3 years. Hence, they actually command the smallest market share as we speak right now. But they also say that the momentum will start to gain up simply because that the whole economy is expected to transition to a greener economy. There has been a long debate in the marketplace in relation to the impact of the transition bonds as compared to the first 3 or the 4 grouping, because when you have a green bond, you specify the use of proceeds for a certain green project. But when it comes to transition bond, how are you going to define transition? So maybe I'll put a step back and just say, why is then transition bond important? So if we were to refer to the agenda announced by the United Nations for the SDG goals, all stakeholders in the economy are expected to contribute to Paris Climate Accord. This would include higher emitting sectors, which are part of the economy, and they also require significant financing in order to move towards a less carbon-intensive operating models. So to facilitate this transition for these type of sectors, there are guidelines such as the ICMA climate issuance-based Climate Transition Finance Handbook that was introduced to encourage issuance based on a defined framework and to reduce the noise or the risk of transition washing. So in order to do so, an issuer is expected to provide climate strategy that reference science-based targets and transition pathways, which should be quantifiable and traceable. Now, this would then ensure the alignment in terms of issuing framework when compared to the first 3 to 4 groupings that mentioned earlier on, which is the green, social, sustainability, and sustainability-linked bonds. This, again, the whole idea to actually introduce the new structure or new type of ESG bond into the market is to really to assist the whole economy to move towards to a synchronized direction and a goal to achieve a greener economy.
It's pretty interesting, fascinating space, and be interesting to see the evolution of that space in the next few years, especially if the projections, come to fruition there in terms of the size of the market. I guess switching gears a little bit and maybe talking a little bit more on the data side of the bond and just the credit market in general. And maybe to start off with, Yoshi, from your side, what do you see as kind of the typical sources or types of data being used in the investment or credit risk area utilized by the industry? And maybe after that, we'll take it from there and start to dive a little bit deeper into some of the areas related to that.
Sure. So when we see the trend in investment strategy or risk management, especially in the credit space, I think the AI or machine learning type of process might be one of the hottest topics. So it is said like a machine learning type approach is a little bit more friendly to credit investment decision because companies' characteristics can be a little bit easier to assess comparing to government bond yield or FX rate. That is a macro, that is a result of macroeconomy. So I'm not very sure, but what I want to say is our clients, like banks and hedge funds, are far more sophisticated than us in terms of the processing of decision making. So our focus should be generating and providing the data that can add value during the process in customer end. So like, of course, the accuracy of data or clarifying the data organization or transparency of the data, the showing the and disclosing as much raw data as possible. That might help clarifying the input data in client side and can help add value, I think. And we have a unique set of conventional and alternative market data with S&P as a firm, like CDS curves or single stock and stock indices, volatility surfaces, bond sector curve, PMI, or commodity at sea, like that shows commodities, what commodities are where on the ocean globally, and heading to where or arriving when. We also see client challenge of collecting basic data like past financial result across numerous active corporates. Our corporate information data provide a consistent history of fundamental data, so we also can help that type of challenges. So to answer your question, Zaid, we have various types of data requirement depending on client's attention or interest. So we need to be very flexible to categorize which data is to which use case. And honestly, I cannot draw the line between conventional and alternative market data personally.
Okay.
So by the way, so Zaid, you obviously have expertise on the market leading consensus service, our market leading consensus service, and probably you have a lot of discussion on cutting edge products like XVA or credit options or structured bonds with international investment banks. So probably, so I think probably you can show some color or discussion of background of valuation management.
Yeah, no, I mean, consensus services that run under kind of the totem service is pretty interesting in the sense that it does provide data and information related to instruments, specifically derivative instruments that are difficult to value or where information is not really publicly available or difficult to source. And that's the idea behind consensus service, which is the main market participants coming together via the totem service, providing their best estimates of the valuations of these instruments and getting back the market consensus view of the valuation of these instruments. And as you know, Yoshi and Paige, that service kind of runs across all the major asset classes, not just the credit, but rates, FX, equities, commodities. And I guess within the credit space, what you typically see there includes credit options and even things like valuation adjustments. You touched on CVA or credit valuation adjustments, Yoshi, that's provided under the XVA service as well, XVA consensus service. So really the output there is being used for kind of verifying and testing your valuations and your kind of balance sheet estimates before publishing it to the street. So it formed really a pretty important function especially in the kind of the banking industry, where you have separate independent functions internally tasked with price testing, verification of the valuations there of the books and records. So within the credit, as I mentioned, you have a range of different services that speak to these kind of derivative instruments and valuation adjustments, DVA, CVA, FVA, and others as well. I guess, Yoshi, just before we wrap up that particular subtopic, you mentioned the bond sector curves, and it's an interesting area, but just for those in the audience or listening in who are not very familiar with what a bond sector curve is, can you give us like an idea what these are and what are they typically used for by the market participants?
Yes, thank you. So the bond sector curves are the derived data calculated from sovereign agency and the corporate bond prices across the globe. So we input more than 300,000 bond prices to publish more than 2 million curves every day. So it is a result of multiple regression with factor matrix from 33 country risk, 15 currencies, and up to 30-year maturities, 55 sectors, and even 3 layers of the seniority. So bond sector curves are used for valuations and risk management against various types of portfolio, including liquid asset and private debt. As customer can choose the most fitted curve to the particular asset they hold. So sector curves has sufficient history data that can contribute to various risk management activities as well, like calculating value at risk. Sector curves also considered as input data of ECL, again, the expected credit loss. Customer calculate PD from sector curve using their own historical recovery rate. That is a typical case of use case. So this ECL concept will be used further in credit risk assessment, as we know, like calculating credit risk asset under Basel II final or valuation in IFRS 9 type of accounting standards, and more will come, I think.
Okay, and I guess when we're talking about kind of the customers who typically use this data, would you say that's like across, sell side to buy side, or is it certain kind of type of market participants who would want to view this data? And maybe within, like, what are the typical, like from your experience, Yoshi, who are the typical users in these institutions? Is it like the risk managers, or is it the fund managers, or the credit traders?
Sure. So mainly for the moment, the banks to manage the credit portfolio. That is the number one priority of the usage of data. But again, I believe this sort of ECL approach can be adopted by broad type of financial institutions for the risk management as well as investment strategy. So I hope we can discuss further with more segment of clients going forward.
Perfect. Yeah, pretty interesting. And maybe Paige, you talked about ESG earlier, and staying on the topic of the data side of this industry, what are, and same question to you as I asked Yoshi earlier, what do you see as kind of the different types and sources of the data being utilized by the ESG bond market kind of participants?
Sure. So as per Yoshi comments earlier on, when the market develops, there will be more data point made available to various use cases, like the say of investment analysis or risk management purpose. So now coming back to ESG space, I would then summarize the current vast pool of ESG data that we see in the marketplace into 4 broad categories, which all 4 have relevancy in credit space in one way or the other. So let's just start with the first category, regulation-related data set that is used by the market participant for, let's say, reporting purpose for the likes of regulation like TCFD or SFTR or even the green taxonomy requirement. Now, the second grouping refers to scientific and modeling data that consists of, for example, the GHG, the greenhouse gas emission data. May it be reported or modeled? And then we also have net zero pathway or scenario, as well as physical and transitional risk factors that are actually important information that you feed into what you call as a climate risk management engine to then project what will be the climate scenario and then what type of risk or business risks associated with that particular scenario. Now, the third grouping refers to entity level, or we call the issuer level information, such as it can be qualitative and quantitative. So the qualitative, the most commonly seen one will be the ESG rating or ESG score for an entity. We also have science-based data such as the GHG emission data reported at the entity level as well. The last grouping refers to the instrument level terms and condition and pricing information. If I were to put this into the perspective of a bond market, so let's say, for example, a bond, an ESG bond, for example, a sustainability linked bond that I mentioned earlier on, there will be information related to the ESG element of this bond. When we talk about sustainability linked bonds, you will actually have a KPI or SPT specified, as in what are your ESG goals that the issuer must actually achieve in order to then have hit the a different financial structure incentives, such as a reduction in the coupon payment or even a lower redemption amount at the end of the maturity date. Now, these are what we call as terms and conditions at the bond level information. We also have bond pricing for a green bond, social bond, sustainability bond, or even transition bonds. So you can split that into a primary market pricing discovery as well as secondary trading information. You combine the two, chances are you come about a buzzword called greenium, which is where you can assess the same issuer when they go to the green bond market to issue, let's say, a green bond versus a conventional bond. And if there's any price difference, this might be caused by actually the demand and supply dynamic from the ESG investment community as we speak today. So now, to then summarize all these 4 categories, I would believe that actually entity level ESG rating score as well as instrument level TNCs and pricing data represents the 2 most popular category that is widely used by the investment community for credit assessment purpose. Now, on the other hand, modeling data will be crucial for climate risk management, particularly for banks where credit risk management is one of their main area of concern, such as if they need to then quantify the impact of physical risk on the bank's real estate loan portfolio. For example, how will the real estate collateral value be affected by flood? So again, to summarize, there's vast pool of ESG data that's available in the market right now. But if you were to sort of like summarize them based on the use cases, I think these are the 4 main groupings that we observe commonly in the market as we speak today.
And maybe just on 2 of those 4 groupings, the kind of the issuer level and the instrument level. I guess just spending a couple of minutes on this, do you see market participants, do you see kind of these, for example, entity level scoring to be, as well as instrument level scoring, not necessarily to be 100% overlapping, so that you could have a different score for the instrument level versus the issuer level? Does that happen in reality? Maybe especially when you kind of link those to the sustainability linked bonds, where you kind of need to dive into all the way down to the instrument level to identify the score. Maybe if you spend just a couple of minutes, Paige, if you can talk a little bit more about the differences between the issuer and the instrument level, it'll be, I think, pretty interesting.
Thank you, Zaid, for this question. In fact, I think this is one of the data challenge actually that a lot of market participants face these days when it comes to comparing an entity level ESG score to maybe an instrument level ESG quality or also score from score perspective. Now, I'm just going to put things into, again, perspective. You may have an oil and gas company that is rated very low in terms of the ESG score, maybe particularly from the E element, as we know that because they are carbon intensive operating industry. But it doesn't stop an oil and gas company to also then try to transition to a greener economy by also shifting their carbon intensive model to a more greener sustainable operating model, which is why you will find that some of the oil and gas company, they are also heavy investor when it comes to renewable energy R&D. And if a particular bond is issued for the purpose and solely for the purpose to finance renewable energy generation, these bonds can be classified as pure green bonds, and they really have a direct impact to the environmental benefit. So there will be chances where the entity level ESG score might differ from the instruments that they issue, where they have stipulated specifically where the use of proceeds are used for or a KPI that they need to achieve. So this is quite commonly seen right now in the market space, as early on when I mentioned that there's 5 broad different types of ESG theme bonds in the market. Each and every of them do play a role to help to move the whole entire global economy to a transition to a greener economy. So I hope that answered the questions.
Yeah, no, it does perfectly well. And maybe just one last question to you, Paige, on this topic. You mentioned kind of the challenges in sourcing this data. Is the market still finding it difficult to source the ESG kind of data related to bond issuances specifically, or bond and issuer? Do you see this data readily available everywhere, or is there kind of just general sense of difficulty in kind of market participants having this data available, like the ESG ratings that you mentioned available all the way down to the instrument level? Just if you can just touch on or elaborate a little bit more on the challenges involved and faced by the market participants when it comes to kind of getting this type of data along with things like the bond pricing and liquidity metrics.
Sure. I think maybe I'll put a step back to really put into the context of the ESG data that's available in the market right now. As earlier on mentioned, there are already 4 broad categories, and I've actually summarized it because based on the use case. But as we speak today in the current market for ESG space, we have a lot of ESG data. But then you need to then start to group them into what are their use case for. And then from there, you will also find out challenges of how you have to manage these ESG data for your day-to-day usage. Now, maybe I'll start with the first commonly cited challenge faced by the market participant when it comes to ESG data usage. I think as earlier mentioned, there are a lot of ESG data in the market. In terms of diversity, you have different types. And each type, they have different data format. For example, a scientific data is very different from a qualitative ESG score data. And then on top of that, you have different data vendors. They have different methodology in generating all this ESG data that is used for various purposes like investment all the way to risk management. Now, you add these 3 elements into one. This represents a very big challenge for any market participant to first, how do you source this data externally, and how do you then process this data internally? As I just mentioned, different types of new data require different data framework, and it also requires different systems to ingest. And institution also need to then ensure there's a right pool of talent that can actually assist you to first source the data, onboard the data, and then manage the data on an ongoing basis for your day-to-day operation in investment all the way to risk management. So the first and foremost, I would say the most obvious challenge out in the market is how do you manage this data? Now, the second goes into like what you have mentioned earlier on, Zaid, about the if the data is available. So it's also commonly cited by a lot of market participants that there's disparity observed in terms of data availability as well as quality by several aspects. Let me just start with, let's say, if you zoom into by sector. Some mainstream sector, as I mentioned about like oil and gas or even shipping on aviation, you have big and listed entities in this kind of segment. Chances are you'll be able to observe more reported ESG data points that will act as a strong baseline for investment analysis as well as for risk management reporting purpose. But if you move the spectrum to not so mainstream segment, for example, fishery, that you don't really have a lot of listed entities in this sector, you will then notice that there will be data gap, and then you will not be able to actually perform the same type of deep analysis that you would have been able to do so in the mainstream segment like the oil and gas or even the shipping industry. Now, if you put this to another angle to look into this, it will be by region. It's actually commonly observed that climate-related information or scientific data, you will have more data points from reported for developed countries or developed market versus a developing. And this is actually quite also a challenge for the other parts of the world, like say of Africa or even APAC countries, to try to do a very wholesome climate risk scenario analysis compared to their counterparts in US or even in European Union, simply because you might not have the full scale of climate statistics to run the full analysis. Last but not least, the data challenge that is also reported by a lot of market participants is about, early on I mentioned about the methodologies. So basically, you have inconsistency in the methodology as well as the inputs that you source to produce, let's say, for example, the ESG score or ratings. This is given because the inconsistency is caused by the fact that different providers, you have different proprietary scoring models, and you have different input or sources. So again, if you add this all together, it again brings another challenge to the market participant, for example, a portfolio manager who wants to actually compile a portfolio analysis by looking into the various rating or scores by the issuer all the way to the instruments. But then you probably have several data vendors providing you the information. You will need to then figure a way to manage the data and then to sort of like reduce the noise and then put it in a common scale so that you can have a meaningful portfolio analysis. So to summarize, these are the few commonly observed data challenge within the ESG space.
Yeah, no, thanks for that, Paige. Pretty interesting, and I guess it speaks to just a final point I wanted to bring in front of you, which is the kind of the data governance aspect of it. Paige, you mentioned kind of the the choices and the challenges faced by a typical portfolio manager, and when sorting through the different types, different conventions, and different inconsistency. And maybe, Yoshi, just from your side to wrap it up, like when we're talking about data governance in the context of credit markets in general, including the bond ESG market, what would you say is that role of data governance that speaks to all this?
Sure, thank you. So, as Paige described on the ESG, ESG factor is very important for the next credit model in next 10 years. So the simplified view is that instrument level data for screening the target of investment or ESG, entity level ESG score to manage or hedge the risk in the portfolio. That would be, it's not that simplified. We found it. And that's that numerous data and analysis or measurement will be required. And it will be implemented into the pricing in the market. So we can say that market develops every day. So more products and more information are available today than yesterday. And of course, market provides a severe process of the scrap and build, so that we need to monitor which product is still tradable and which products are not tradable anymore. So at the same time, conventional data, alternative data, structured data, unstructured data are used for the investment and risk management process these days. So now we can say that we have too much data. So I think the role of the data governance is choosing the right data for decision making. I heard a famous quote from a data scientist saying garbage in, garbage out. So the quality of input data is quality of output, obviously. So no matter how good the process already, we need to be careful about the data we will use as an input. So data governance or knowledge of data leads better decision in less noise, which means less resources. We can also say less cost. I think that in the aftermath of IHS market, the merger with S&P, our valuation and pricing data support financial institutions to make market-beating decision across valuation, risk management, or investment, or trading with data governance and data intelligence. So very much excited to do it further with you all.
Thanks for that, Yoshi. And it's really a nice way to wrap up kind of the main section of our discussion. And I think we've got just about enough time to take maybe one question that was put forward, and that's to do with Paige, you kind of talked about the ESG bond markets and the data side, the challenges, maybe specifically within the APAC region and specifically on the regulatory front. The question is to give us an idea of kind of the ESG regulatory framework in APAC, but obviously it's a big topic. Maybe just if you can spend a couple of minutes talking about kind of just some of the key developments there and key regulatory updates across APAC that are worth noting.
Sure, thanks, Zaid, for the question. So maybe before I zoom into APAC, let me give more of an overview of a global regulatory landscape. So the regulation landscape has actually evolved in conjunction with the rapid rise of the ESG bond market for the last decade. So but if you were to look into how the development has actually moved, I would say there's two main directions. So first will be commonly seen is that the regulation has come about to provide a coherent framework or standard for bond issuance and offering purpose. Now, the second one would be that to provide guidelines for market participants to do like reporting, auditing, and governance rules to avoid any greenwashing or transition washing. So further expanding into these 2 points, so most of the global guidelines and framework are voluntary or market-based initiatives. So for example, the issuing framework that I mentioned earlier on, you can find that there are two mainstream framework out there in the market. One is the Green Bond Principle issued by the SAMA, and the other is Climate Bond Initiative Standard by the CBI. Now, in terms of reporting guideline, globally, there are two also, here there are many, and then I'll just mention two briefly. So the first will be TCFD, and then the second will be PCAF, the Global GHG Accounting and Reporting Standard for the Financial Industry. So now, if you then bring the move on from global landscape to the APAC, or even to the regional or individual jurisdiction perspective, you find that individual jurisdiction often refers to the global standard or even cross-border initiative as a reference framework, and then they will modify and adjust to factor in local context. For example, you see that we have ASEAN Green Bond Standard. So while the Green Bond Principle from the ICMA has provided a broad principle on green bonds issuance, the ASEAN Green Bond Standards aims to provide more specific guidelines on how the GBP can be applicable across ASEAN countries. So this will actually promote cross-border transaction among the ASEAN bond community. Now in Japan, similarly, we see the Green Bond Guideline published by the Ministry of Environment back in 2017. This has remained the main source of regulation guidance for the Japanese company when they plan to issue any green bonds in the Japanese domestic market. Now, again, similar to the ICMA GPP, they have four main pillars: the use of proceed, the process for project evaluation and selections, management of proceed, and lastly, reporting. They also recognize the need of external review. Now, on top of that, you'll then also see that there are actually more interaction between within the financial market to try to promote green investment, which is why then the FSA and the Tokyo Exchange are now creating a framework to certify green and transition bonds ahead of the launch of a specific or dedicated segment on the exchange to try to then promote more green investment on a national level within Japan. Now, lastly, I would also like to touch on what's happening in China. So China represents one of the largest green bond issuer globally, as well as in APAC. Now, in China, much of the work has been actually focused or done in defining the taxonomy, which details a list of economic activities that are recognized as having substantial contribution to mitigate climate change. So there are actually, if you were to look into the whole market space, if I may summarize, there are three main regulatory bodies governing three types of entity when it comes to issuing green bonds. So the first one will be green bond issued by the financial entities, i.e. the banks, are subjected by the PBOC green bond endorsed project catalog. You also have green domestic corporates that are subject to the NDRC guidelines. And then lastly, green bonds by listed companies subject by the CSRC guidelines. So to unify all these standards in 2021, the three regulator has then sort of come with a common catalog to promote green investment in the national level. So as we speak, each of the jurisdictions are now really adjusting their requirement and then also come up with more guidance and as well as market standards to the marketplace.
Paige, thank you very much. That's pretty interesting, and it's a fascinating space to keep an eye on. I think with that we've run out of time, but thank you very much, Paige and Yoshi, for joining us today, and talk to you soon. Thank you.
Thank you.
Thank you.